take a look at the market today for March 11th, 2025. And it was a continuation of the sell-off, but we certainly had a bounce back day overall. I mean, it seemed like that, especially when you look at the S&P down about 0.75%. The NASDAQ was down about 0.25%, and the Dow down over 1%. So you might say, okay, that's a bad day in markets, but you actually had some decent reversals off the lows. There was some major support around the 5,500 level on the S&P, and we closed at about 5,572. Pretty nicely off those lows of the session. So once again, still a mixed bag. You had Apple down 3%, but Nvidia was positive. Same with Broadcom, Amazon, Meta. Definitely the names that had been sold off the most, those got a bit of a bounce. Now, part of this is exhaustion, what we call gamma hedging unwind, which is basically when the dealers who are selling these options suddenly are no longer needing to sell off positions anymore. They just are fine with where they're at. And so you didn't have that pressure to the downside. That's really what drove this sell-off, was that unwinding of some major options positioning. And that unwind, at least for the short term, is largely done. And so that's why what's likely to occur here is some sort of at least pause in the sell-off. Could you get more continuation? Sure. But it would not shock me to get a decent bounce in markets from here. We hit major support, 618 retrace on the S&P from the yen carry trade unwind lows and from last summer. And so overall, just everything's kind of lining up for, odds are good of a pause or a bounce. Now, once again, no guarantees in markets, but that's kind of what you're setting up here to see most likely. What else happened in markets? You had the dollar continuing down 50 basis points. Gold was up 70 basis points, 0.7%. Bitcoin back above 80,000 at up about 5.8% on the day. And oil, WTI crude, up about 0.3% off its best levels. So this was an interesting day in markets. Some similarities to what you've seen over the past few weeks with the sell-off, but some major differences as well. Mainly, it was, once again, that bounce back of those major tech names, and a lot of those consumer staples that have been really crushing and doing very well, they actually were down on the day. You had Procter & Gamble down almost 2%. You had Visa down nearly 3%, MasterCard down 2%. The banks continue to be relatively weak, but healthcare, you're actually starting to see sell-offs there as well. AbbVie down about 1.4%, Pfizer down 2.4%, Gilead down 2.4%. So some of the names that were good relative strength winners over the past couple of weeks, those came off today, while you got bounces in, like I said before, Netflix and Meta and Nvidia, Broadcom, Amazon, etc. Even the telecoms, your AT&T, Verizon's, and T-Mobile's of the world, Verizon was down 6.5% today. T-Mobile down 4.6%. So you're getting, markets starting to change a little color, very different. And that's another sign that, hey, a bounce might be in the offing. Now, how strong will that be? We shall see. You can't judge it until you see the pitch, right? You can't swing at the pitch unless you recognize it and see it. So I don't want to sit here and say, oh, this bounce is going to be huge or minor or somewhere in the middle. We just have to wait and see. So that was the market today. Turnaround Tuesday. We kind of had a turnaround Tuesday a little bit, but certainly there's more work to do. I've said this before. To get a durable bottom, we need to be above pretty much, let's take a look here, pretty much above yesterday's highs. Okay. And on the S&P, that's around 57.12. Okay. 57.12 in that range. And if you can get a close above that, then once again, you could get a durable bottom that could last weeks or months, right? But until then, the path of least resistance is still lower, even if you get some chop from here, because those gamma hedging unwinds are kind of behind us for the short term. So that was the market today. Very interesting underneath the surface. Very different type of market, despite the red headlines continuing on the indices.